Ever feel like no matter how much you earn, your bank balance doesn't reflect it? You're not alone. A surprising number of people find themselves stuck in a financial rut, wondering why they aren't getting richer. But what if the answers are simpler than you think, hidden in plain sight within your everyday habits? Recent studies reveal that the average American spends up to $1,497 per month on non-essential items. That's nearly $18,000 a year on things we might not even need. These spending habits are subtly eroding our financial futures, making it harder to achieve the richness of life we all seek. In this video, we're diving deep into the common financial traps that are likely holding you back. From the seductive allure of credit cards and the silent drain of unused subscriptions to the deceptive comforts of not having an emergency fund, we've got you covered. We'll explore not just the problems, but practical strategies to sidestep these pitfalls and start accumulating wealth. Stay tuned as we unpack these topics and more, helping you turn your financial life around, one smart decision at a time. Let's get started on a journey to not just make money, but to keep it and make it work for us. Chapter 1. The Money Mirage. How keeping up appearances is draining your wallet. Have you ever wondered why, despite earning more than ever, you don't seem to get any richer? You're not alone. Many fall into the trap of lifestyle inflation, where with every salary increase, spending increases too. It's like running on a treadmill where you sweat a lot but don't move forward. According to a recent study, nearly 40% of Americans admit to spending money on things they can't afford just to keep up with their friends. This keeping up with the Joneses mentality is a fast track to financial disaster. It's not just about buying the latest gadgets or flashy cars. Sometimes, it's the weekly brunches and extravagant vacations that slowly drain your bank account. Financial expert Dave Ramsey once said, "We buy things we don't need with money we don't have to impress people we don't like." It's a humorous observation but painfully true. The reality is, the temporary satisfaction of looking wealthy can permanently damage real wealth accumulation. So, what's the strategy to combat this? First, track your spending. You might be shocked to see where your money is going. A simple budgeting app can reveal how much those little indulgences are actually costing you over time. Second, set clear financial goals. Whether it's saving for a house, investing in stocks, or building a retirement fund, having specific aims helps you stay focused and makes it easier to say no to unnecessary expenses. Chapter 2. Subscription Seduction, the Silent Cash Drainers. Subscriptions are the silent budget busters in today's digital age. From streaming services to software, and even snack boxes, our world is full of small, recurring charges. But do you know how much they collectively subtract from your finances each year? A shocking statistic from the US Bureau of Labor Statistics shows that the average American spends over $237 a month on subscription services. That's almost $3,000 a year spent on things that, often, we don't even use frequently. The first step to getting a handle on this is to audit your subscriptions. Look through your bank statements and identify every single recurring charge. Decide what you truly use and value, and cancel the rest. You might discover subscriptions you forgot you had, money that could be redirected towards savings or investments. Next, beware of the free trial trap. Companies count on you forgetting to cancel a service once the trial period ends. If you sign up for a trial, set a reminder a couple of days before it ends to decide if you really need it. Another strategy is to share costs where possible. Many services like streaming and software allow multiple users. Team up with friends or family to share the expenses, reducing your individual financial burden. Chapter 3. The Credit Card Conundrum, Rewarding or Ruinous. Credit cards can be a tricky business. They promise travel rewards, cashback, and other perks, but can also lead you into a debt trap if not managed wisely. Did you know that the average credit card balance for Americans is over $6,200? And with interest rates soaring, the cost of carrying that balance can be staggering. The first strategy to avoid falling into this pit is to use credit cards like debit cards. Only spend what you can afford to pay off in full each month. This way, you earn the rewards without paying interest. Setting up automatic payments can also help you stay on top of your bills and avoid late fees. Ensure the payment amount covers the full balance, or at least the statement balance, to prevent interest charges. Consider a budgeting method that allocates a certain amount of your income to credit card payments. For instance, the 50-30-20 rule suggests using 20% of your income for debt repayment and savings. Adapting this to your financial situation can help manage debt effectively. Warren Buffett once wisely remarked, "Do not save what is left after spending, but spend what is left after saving." Apply this principle by treating your credit card payment like a savings goal. This mindset shift can protect you from overspending and accumulating debt. Chapter 4. Investment Illusions, Missteps that Mislead. Investing can be an excellent tool for building wealth, but common mistakes often lead to unnecessary losses. For example, many investors chase hot stocks based on tips or sudden market movements, a practice that can lead to buying high and selling low, opposite of the profitable strategy. Start by educating yourself on the basics of investing. Understanding terms like stocks, bonds, dividends, and capital gains can give you a better foundation to make informed decisions rather than following the crowd. Diversification is your best defense against risk. Don't put all your eggs in one basket. A diversified portfolio can help you weather market volatility without devastating losses. According to financial experts, investors with diversified portfolios tend to see more stable and consistent returns over the long term. Another crucial strategy is to invest regularly. Utilize dollar cost averaging by investing a fixed amount into a particular investment at regular intervals. This technique reduces the impact of volatility by spreading out the investment cost and quantity over a longer period. Finally, avoid the temptation to react to short-term market fluctuations. As the legendary investor Benjamin Graham said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Focus on long-term gains rather than short-term appearances. Chapter 5. Emergency Fund Evasions, the Risk of Living on the Edge. Many people overlook the importance of an emergency fund, but did you know that 40% of Americans would struggle to come up with $400 for an unexpected expense? This startling statistic from the Federal Reserve highlights the precarious financial situation that many find themselves in without a safety net. The first step to avoid this trap is to start small. Even saving a little bit each month can build up over time. Set a goal to save at least 3 to 6 months of living expenses. This might seem daunting, but breaking it down into smaller, manageable steps can make it feel more achievable. Automating your savings is a game changer. Set up your bank account to automatically transfer funds to a savings account each payday. This out of sight, out of mind strategy helps you save without having to think about it. Another useful tactic is to stash any windfalls, like tax refunds, bonuses, or gifts, directly into your emergency fund. It's tempting to spend unexpected money, but redirecting it into your savings can significantly boost your financial buffer. Dave Ramsey wisely advises, "You must gain control over your money or the lack of it will forever control you." Treat your emergency fund as a bill that must be paid every month, and you'll find it easier to prioritize savings. Chapter 6. DIY Disasters, when cost-cutting costs more. Trying to save money by doing things yourself can sometimes backfire, especially in areas where expertise is crucial. For example, DIY home renovations can end up costing more if mistakes need professional repairs. According to a study, about 1 in 3 homeowners regrets tackling a DIY home improvement project themselves because of the costs involved in fixing errors. The key strategy here is to know when to hire a professional. For specialized tasks like electrical work, plumbing, or major home improvements, the long-term savings from hiring someone experienced can far outweigh the initial costs. Invest in learning basic skills that can save money without risking big losses. Simple home maintenance, like painting or fixing minor leaks, can be safely handled without much expertise and can save money in the long run. For financial tasks, such as investing or tax filing, consider consulting with a professional if you're not well versed in these areas. An investment in good advice can prevent costly mistakes. As Warren Buffett puts it, "It's good to learn from your mistakes. It's better to learn from other people's mistakes."